move on, quick glance at the market before we move on to our next discussion, which is a very interesting one. The cut is as of now a little deep. 24,400 is under question. So let's keep an eye out on this. So far, no one's venturing in to buy that dip. There is overwhelming negativity in global markets, so no one's trying to do brave things early on. But let's see, it's a long day ahead. We'll figure out how this goes. As of now, market is under pressure. But moving on to another interesting discussion, and it's all about insurance now in our next conversation. The CNBC TV18 news break has been confirmed. The insurance regulator is indeed considering to tighten norms to cover over-dependence on the bancassurance channel. To talk about this, we have with us industry veterans. We have Mr. Nilesh Sathe, former member of the Insurance Regulatory and Development Authority of India, or IRDAI. We also have Rajesh Sood, managing partner at Tisaya Partners, and he's the former executive vice chairman and CEO at Max Life Insurance. Thank you, gentlemen, so much for joining in. So it's a big debate that was stirred up when I think the finance minister made that first statement saying banks should look at their own business, which is banking, and now not look at selling insurance policies that people don't really need. It all started from there. And then now we know that the regulator, industry regulator, is also looking at it quite closely. So, Mr. Sathe, your first thoughts, this whole dependence on the banca channel, whether it is the parent bank or whether it is some other bank that you're tied up with, it's the way in which the industry has been built for the past many decades. Do you think there's a need to change? Is it the time to change this?
No need to change it. Actually, if bank can promote insurance company, nothing wrong in that. And those who have promoted insurance companies have really done well. Even their earning ratios are quite satisfactory, means whatever capital they have invested, they have got good return on that. We have seen it getting reflected in the share price of these companies which are listed also. So I am not of a view that banks should be asked to stop doing insurance business, but it should be properly regulated. It is definitely not properly regulated today because when finance minister herself has said that mis-selling complaints are increasing in case of bank assurance, means they are definitely on rise. And it has to be seen what are the reasons for this. If at all some corrective action is to be taken by Reserve Bank of India, they should take. If IRDA has to take it, they should take. And one thing which is certain, that over-dependence on one channel is always is never good. So it is necessary that there has to be a spread, because insurance is ultimately spreading of risk. So this principle applies everywhere. You should not be over dependent on one channel. So IRDA may definitely take some action on this. A couple of them may be. I'm not sure whether they will take these actions. Asking the banks which have promoted life insurance company or general insurance company not to get more than some specific percentage of business from of that company.
No, absolutely, absolutely. So, Mr. Sathe, we'll come to this. What can be maybe a middle path which is palatable and not totally disruptive. We'll come to that in just a minute. Let's also get in Mr. Sood's thoughts into this. Mr. Sood, you've been a practitioner within the industry as well, right? Technically, one can argue back. Our colleague Yash was giving us the data. Technically, if you say, mis-selling in FY23 as per IRDAI's annual report was just 0.09%. So technically, you can say that I didn't, make a false statement, so I've not mis-sold. But that's not the point. I think the bigger debate is that whether there is so much pressure in terms of selling and the fact that a lot of this is dependency on banks, that whether the policy buyers' actual interests are being served at the end of the day or not. It's a larger debate, I think, that the finance minister has kicked off. So your sense on whether there needs to be a rethink on this dependence on the bank channel and the way policies are being sold?
Thank you. I'll actually answer it from a couple of perspectives. So first and foremost, I would fully endorse the fact that banks everywhere in the world, and particularly in India, I think have tremendous access to customers. They have the widest distribution, and therefore utilizing the channel to spread insurance to cover people is absolutely the right thing to do. And that's what the industry has evolved to see as well. So I don't think there's any going back on the importance of bank insurance as a channel of distribution. The second piece, I guess, that we are referring to here is what is the right way of selling it, and is dependence on only one, let's say, bank partner or a bank promoted partner issue, so to say. I would also argue from a business point of view, it's actually an individual company's strategy. And to some extent, there should be a degree of freedom allowed to that. If somebody believes that they can do well with their incumbent partner and that's all they want to do, that's their choice. Now, risk, yes, there is a risk of dependence, but then that's for the shareholders and the board of that company to manage, of course, within the overall ambit of how the industry structure is evolving in India. Now, thankfully, there have been over the years so many insurers. There are almost 30 each, I would say, 25 in life and about 30 in the general insurance and SAHI combined, that it's not as if there are only a couple of insurers who are dominating this whole distribution channel. So there is, I think, a large kind of play out there where banks can choose and have chosen in the past to go with single insurers or multiple insurers. So that's, I would say, a matter of company choice. The last thing I think, which is the most important piece that you bring up, is where we should talk about what is that particular way in which this governance can be tightened. How do you ensure that customers, when they interacted with banks, or for that matter, any distribution partner, feel that their interests are being taken care of, believe that there was transparent disclosure, that they were not being pushed into a product, but rather they were actually explained what the features were and why it's important. And I think the often quoted thing, everybody needs insurance, but nobody wants it. That's the so-called conflict that we have to resolve. How do you kind of move it from that need to want is the selling process. And it's there, I think, a lot more emphasis, both in terms of practices, in terms of target setting, in terms of incentives, in terms of repercussions in case found to be missold. Those are the dimensions, I think, that need more work.
No, absolutely. I just want to refer to the numbers that we're flashing on our screen as well. And these are really important numbers to understand why stocks get jittery every time this is brought up. Because let's pull this up. I mean, the share of bancassurance for an insurer like HDFC Life is 65%. For SBI Life, it's 58%. So they're getting this much of their business relying on the bank channel. And which are these banks? A large part of it is the parent bank in these entities. So 95% of the bancassurance in SBI Life's case is coming from the parent bank, State Bank of India. Likewise, for HDFC Life, it's about 80 to 85% is coming in from the parent bank. The exposures are slightly lower for the others like Max and ICICI Pru. Mr. Sathe, now let's come in on the point of what thresholds can be, sort of prescribed. What will the industry be okay with? Because, I mean, why should we ignore LIC? LIC has built its entire business on a very different model, on the agent model, not relying on the banca channel as per. And that's also a discussion ongoing, whether that should also be opened up. One agent should be able to sell multiple, policies, just like the mutual fund world. The MF world is not that heavily dependent on the banca channel. And a mutual fund distributor can sell all kinds of funds. So, should this also be considered for insurance?
Two questions. One is on what we call as open architecture for individual agents. And the other is to what extent the parent bank should be allowed to sell the products of the banks, products of the insurance companies, which are promoted by them. As far as heavy dependence on one insurance company is concerned or one bank is concerned for insurance company, both is harmful. But then it should not be reduced to 50% overnight. They should be given some sliding path by way of which they should be asked to reduce it maybe by 10% every year, so on and so forth, up to 50%. IRDA has already allowed insurance companies to tie up with 9 life, 9 general, and 9 health insurance companies. But they have not made it compulsory. Even when it was increased to 3, it was not made compulsory. Initially, most of the banks used to tie up only with one insurance company, but now many have started tying up with more than one. The purpose is the customer should have an option to choose between at least 3 insurance companies, the product that he wants to buy. Now it is increased to 9. But there is no compulsion. There is a possibility that the IRDA may ask these companies to compel, these banks to compel, to be compelled to have tie-up with more than 3, so that the sliding path of share of one insurance company will come down. So this is a possibility. Second is, we have to understand why is it that the banks are over-enthusiastic in selling insurance products and not mutual fund products, because both are financial products. And the most important, probably the reason appears to be the amount of revenue that they get by selling insurance products, because insurance being a
Absolutely.
push product,
Yeah.
higher rate of is there and higher base income is generated. So obviously they are more keen on selling it. So targets are given, whether targets should be given.
Absolutely, sir. And that is the entire framework that is up for debate today. Rajesh, last word with you. We only have 30 seconds left. Give us your prescription, something that you think will work for the industry as well, and start meeting these larger objectives, that questions that are being asked in terms of selling the right product to the right customer and not pushing beyond a point. So what is the threshold? Mr. Sathe said that, say, if you say that the parent bank contribution should not be 50% and you bring it down to 50% over a couple of years, is that something that's palatable to you? Just leave us with the specifics. What should be the percentage? How many years should be given to come down to it? And also this thing of tying up with multiple insurers. A bank should have, 5 insurers, 6 insurers. What would your recipe be or prescription be?
I certainly would advocate multiple insurer tie-ups. That for sure is something that I believe is healthy because it promotes competition within the industry as well and certainly offers choice to the customer. But the second part, I think, is where I would emphasize that how is that choice being offered to the customer needs to be worked upon. Today, actually, there is no check back on whether a customer was given an option or not. So maybe from a conduct point of view, I would think some more areas, like we have an illustration as an example, which the customer is kind of required to sign and receive. So again, is there a necessity to show at least 2 products which are competing in the same genre of whatever the customer is wanting to buy? It could be one way of looking at how do you really bring choice to the forefront rather than it just being a theoretical construct that there is choice. That'd be one option, I'd say. The other would be, I think, and some work has already begun on that, which is back-ending the reward structures, where instead of a lot of money being, let's say, upfronted, there's a little bit of move now towards having more renewals and trail-based income, and that improves persistency for the industry. It's great for the customer. It's good for the distributor. Obviously, there's a change management piece there, but I think that's already begun, and maybe that needs to be accelerated a bit more. That will also take away some of this overly, aggressive pushing that might happen for front-end sales. And the last, I would say, I would be careful about prescribing any percentages on what should be the number. But as Mr. Sathe also said, I think a pathway, a gradual way to kind of comply with a certain diversification norm should be the way I would say it. But remember, some of these companies have also formed joint ventures with banks, and there was obviously some commercial consideration given for that. So that all will need to kind of be allowed to play out so that nobody feels that this was a late stage change of their structure. So I think those would be the 3 things that I'd say.
Okay. Gentlemen, thank you very much for joining in. Very interesting discussion. And I think this topic is going to come up again and again. For now, we'll slip into a very short break. On the other side, we'll invite the management of International Gemological Institute. Their IPO opens for subscription today. They're looking to raise 4,225 crore rupees. So we'll get discussing with the top management.